Whether you are a resitter sitting ATX under a different Finance Act, or you studied TX last year and want to know what has changed from your previous studies, this video is for you. I run through the main changes in the Finance Act 2024 that impact on the ATX UK syllabus from the previous Finance Act. The dividend nil rate band for individuals in income tax has dropped from £1,000 to £500, not so great for taxpayers. Remember, this is the amount that they can get tax-free against taxable dividend income and is available to all taxpayers whether they are basic rate, higher rate or additional rate taxpayers. Company share option plans are one of the types of tax advantage share schemes available to employers to provide their employees with shares in the company. The maximum value of options that can be held by the employee is now £60,000 at any one time, whereas it was £30,000 before. All other conditions remain the same. The Seed Enterprise Investment Scheme is a special type of investment where an individual can get some relief from income tax as a result of the investment. The maximum qualifying investment that can be claimed on is now £200,000 rather than £100,000. So that means now that the maximum deduction from income tax in a tax year is £100,000, which is 50% of that £200,000. All of the other conditions remain the same. One of the rates on Class 1 NIC has changed. For employees, it is now 8% on earnings between £12,571 and £50,270 compared to 12% before. Everything else in Class 1 NIC is the same. You should use your tax tables to help you anyway. Don't try and memorise any NIC rates or thresholds as they are all available for you in the exam. NIC for self-employed individuals has also changed, with Class 2 NIC being abolished and one of the rates for Class 4 NIC being reduced from 9% to 6%. Again, use your tax tables. Don't try and memorise this. These are easy marks to get in the exam, so take no risks, check them. The default approach for sole traders and partnerships is now the cash basis, whereas it was the accruals basis before. And you're to assume that the cash basis is the approach being taken by them if the question in the exam is silent about it. The main feature of the cash approach is that there's no distinction between capital and revenue expenditure because we're just dealing with things as cash is coming in and going out of the business. If instead of using the cash basis, a trader was using the accruals basis, then the approach to arriving at the taxable trading profits would be quite different. Sole traders and partnerships can elect to use the accruals basis if they wish. Companies will need to use the accruals basis. They don't get a choice. Over recent years, the rules have changed on how unincorporated businesses are taxed, and as a result of those changes, some people will have ended up with a larger amount of profits than perhaps they were expecting, and these need to be taxed. There are some transitional rules that allow these additional transition profits to be taxed by spreading them out equally over 5 tax years starting with 23-24. An individual can choose if they want to add these profits into their tax returns sooner than that, so maybe putting them all in 24-25, for example. This is not good for their cash flow situation, but maybe they know that in one particular year they will be a basic rate taxpayer, but in later years they will be higher rate or additional rate. So maybe it's better to pop these extra profits into a year when they know they'll be taxed at a lower rate. Elections to have transitional profits taxed earlier need to be made within 12 months of the filing date for that tax year. Any remaining transitional profits are then spread out over the remaining tax years of the original 5-year period. The exam question will give you the amount of transitional profits as at 23-24 and the amount already subject to income tax. Transitional profits go on a separate line in the income tax computation, but still treat them as non-savings income, so keep them separate from other trading profits for the period. You will not have to do any calculations of the actual transitional profits amounts, as those rules are not examinable. The new system for working out how to put taxable trading profits for individuals into the right tax year involve us taking the profits that arise in a tax year and taxing them in that tax year. So it is much more straightforward than it previously was. So for example, the profits for the year ended 31st March 25 will simply be taxed in the tax year 24-25. Any unincorporated business that does not have a year end of the 31st of March or the 1st, 2nd, 3rd, 4th or 5th of April, they will need to time apportion their profits to fit into the tax year. A business that starts during the tax year will use their profits from day 1 of the trade up to the 5th of April in that tax year. We might have to use some estimated figures, but these can be amended within 12 months of the tax return filing date. If the unincorporated business ceases to trade, taxable trading profit is going to be from the 6th of April to the date of cessation. Any remaining transition profits will be taxed in the tax year of cessation. There might be some post-cessation income or expenses that were not included in the final period's tax return. For income, we would tax that in the year of receipt as miscellaneous income. But you can elect for it to be taxed in the year of cessation instead. Expenses in the 7 years after cessation can get tax relief in the year that they were paid against any post-cessation income that year. Claims need to be made for both post-cessation income and post-cessation expenses. The annual allowance is what will claw back any excessive amounts of tax relief given further up the income tax computation for pension contributions. So the annual allowance is currently sitting at £60,000 for tax years 23-24 and 24-25. Prior to that, it was £40,000. Now, if you sat an exam in 23-24, you would have used £40,000 in that year. But please note that now we are using £60,000 for 23-24 and £60,000 for 24-25. This information is on your tax table, so you can double check it if you need to in the exam. If someone is considered to be wealthy, we will reduce the amount of annual allowance they're permitted to have in a year. If an individual's adjusted income is more than £260,000 in the tax year, the allowance will be tapered. The figure was £240,000 previously, but you only need to know the £260,000 threshold. Adjusted income is net income plus employee contributions to occupational schemes. These will have been deducted in working out their net income, plus employer contributions to all schemes, whether they be occupational or personal. It's reduced by £1 for every £2 that the adjusted income is above £260,000. It cannot be reduced below £10,000. If someone has adjusted income of £360,000 or more, then they will only get this £10,000 minimum allowance, so you can save yourself some time working it out if you remember that. Previously, the minimum allowance was £4,000. We don't have to taper brought forward allowances, just the one for the current year that we're working on, but you may be given tapered figures from previous years to bring forward to this year in the exam. A couple of changes in capital gains tax are that the annual exempt amount is now £3,000 rather than £6,000, and the rate for residential property at the higher rate is now 24% rather than 28%. This information is available to you in the tax tables in the exam, and you're not expected to know previous rates. A slight change in rule regarding no gain, no loss transfers between spouses or civil partners. If the couple separates, then the special no gain, no loss rules only apply until the earlier of the last day of the third tax year following the tax year in which the couple separates, and the date on which their marriage or civil partnership is legally brought to an end or the separation is legally recognised. In VAT, the only changes we have are that the VAT registration and deregistration thresholds have changed. So again, use your tax tables if you're in any doubt in the exam. To encourage businesses to spend more on research and development, additional tax relief is given if a company spends money on qualifying research and development. These businesses will already be able to deduct the expenditure against its trading profits. What we're talking about here is an extra tax relief on top of that, which is given under a scheme called the Research and Development Expenditure Credit, RDEC or RDEC. This replaces the previous R&D relief that you may have learnt about, and the RDEC scheme applies to all sizes of company. Expenditure that qualifies for additional research and development tax relief is revenue expenditure like salaries, payments to agency workers, consumables, computer software, subcontractor expenditure, although there is more to discuss on that point, so we will come back to that one. Capital expenditure does not qualify for R&D relief, but it can get 100% capital allowances, and then when disposed of later on, will create a balancing charge. Nor does rent qualify for RDEC or any costs that are not specifically for the research and development. So we couldn't have general admin or staff who, if they weren't working on the R&D project, would just be doing other work for the company and still getting paid. Usually it is the company that decides to carry out the research and development that makes the claim for relief, but the work might not be carried out by them. It may instead be subcontracted to another company. Where payments are made to unconnected external workers and contractors, there's a cap of 65% on the expenditure that will qualify for enhanced tax relief. Whereas if the work is carried out by a connected person or company, then the amount of R&D tax relief that can be claimed is the lower of the payment made to the connected contractor and the relevant expenditure incurred by the connected contractor. Connected means controlled by the same person or one controls the other. They can jointly elect in writing within 2 years of the end of the engaging company's accounting period where the contract is made to be treated as connected, and this would apply to all payments then under the same contract. To operate the RDEC scheme, you will add 20% of the qualifying R&D expenditure to trading income in the corporation tax computation. You will then deduct 20% of the qualifying R&D expenditure from the corporation tax liability as a tax credit. If the company doesn't have any corporation tax liability, or there's not enough to net off all of the tax credit, the excess can be carried forward and set against the first available future corporation tax liability, or it can be group relieved, or it can be paid out in cash. Capital allowances for companies are mostly just the same as they are for unincorporated businesses, but a significant difference has come in more recent times referred to as enhanced capital allowances. A new set for you to be aware of in Finance Act 24 applies to companies only from the 1st of April 2023 on the purchase of new plant and machinery. We have 100% first year allowance, which is also referred to as full expensing, and we have a 50% first year allowance. The full expensing is for assets that would qualify for the main pool. There is no upper limit to how much can qualify for this full expensing. There would be a balancing charge when an asset that claimed this 100% first year allowance is disposed of. Balancing charges increase your trading profits and therefore your tax liability. So we should be targeting our AIA first, and only any excess of qualifying spend over the AIA limit should use full expensing. For the 50% first year allowance, this is for special rate pool assets, and again there is no upper limit to how much can qualify. Just watch out that enhanced capital allowances are not available on second-hand assets. They're not available on cars, connected party transactions, or any assets bought in the final period of the company's trade. So the AIA should be claimed before enhanced capital allowances against purchases in the following order. Go for second-hand special rate pool assets first of all, as these would otherwise only get 6%. Then second-hand main pool assets, because otherwise they'd only get 18%. New special rate pool assets, but only if there is an excess over the AIA limit, would we then look at the 50% first year allowance this year, and then in future we'd have the writing down allowance of 6% on that balance. Then we'd look at new main pool assets. Again, if we've used up all of the AIA, then we would look at those special enhanced capital allowances, so the 100% first year allowance for that one. So there is no need to consider these enhanced capital allowances unless all of your AIA has been used up. Another complication that you might have to deal with then is the disposal of assets on which enhanced capital allowances have been claimed in the past. Now, there was a super deduction of 130% in the past, which you may be familiar with from previous studies. This super deduction is not applicable on acquisitions anymore, but in your exam you might have to deal with the disposal of assets where it had been claimed. We might also have to deal with the fact that we are disposing of an asset on which that special 100% first year allowance has been claimed. In both of these situations, a balancing charge would be triggered on disposal equal to the disposal proceeds figure. Things are a bit more complicated where in the past a 50% first year allowance has been claimed. Because in that case, yes, there is a balancing charge triggered, but it's only equal to the proceeds multiplied by the proportion of expenditure on which the first year allowance was claimed, multiplied by 50%. And then the remaining amount of the proceeds figure are deducted from the balance in the special rate pool before the 6% writing down allowance is then calculated in that pool. I hope that's been a useful summary for you. Please make sure that you subscribe to my channel so that you get notifications of when new videos come up, where I'll probably be going through some of these issues in more detail with some examples.